U.S. Treasury Department that, in most years, should produce a significant benefit for charities of your choice. Each Berkshire shareholder, on a basis proportional to the number of shares of Berkshire that he owns, will be able to designate recipients of charitable contributions by our company. You will name the charity. Berkshire will write the check. The ruling states that there will be no personal tax consequences to our shareholders for making such designations. Thus, our owners can now exercise a perquisite that, although routinely exercised by the owners in closely held businesses, is almost exclusively exercised by the managers in more widely held businesses. In a widely held corporation, the executives ordinarily arrange all charitable donations with no input at all from the shareholders in two main categories. 1. Donations considered to benefit the corporation directly in an amount roughly commensurate with the cost of the donation, and 2. Donations considered to benefit the corporation indirectly through hard-to-measure, long-delayed feedback effects of various kinds. I and other Berkshire executives have arranged in the past, as we will arrange in the future, all charitable donations in the first category. However, the aggregate level of giving in such category has been quite low, and very likely will remain quite low, because not many gifts can be shown to produce roughly commensurate direct benefits to Berkshire. In the second category, Berkshire's charitable gifts have been virtually nil, because I am not comfortable with ordinary corporate practice and had no better practice to substitute. What bothers me about ordinary corporate practice is the way gifts tend to be made based more on who does the asking and how corporate peers are responding than on an objective evaluation of the donee's activities. Conventionality often overpowers rationality. A common result is the use of the stockholders' money to implement the charitable inclinations of the corporate manager, who usually is heavily influenced by specific social pressures on him. Frequently, there is an added incongruity. Many corporate managers deplore governmental allocation of the taxpayer's dollar, but embrace enthusiastically their own allocation of the shareholder's dollar. For Berkshire, a different model seems appropriate. Just as I wouldn't want you to implement your personal judgments by writing checks on my bank account for charities of your choice, I feel it inappropriate to write checks on your corporate bank account for charities of my choice. Your charitable preferences are as good as mine, and for both you and me, funds available to foster charitable interest in a tax-deductible manner reside largely at the corporate level rather than in our own hands. Under such circumstances, I believe Berkshire should imitate more closely held companies, not larger public companies. If you and I each own 50% of a corporation, our charitable decision-making would be simple. Charities very directly related to the operations of the business would have first claim on our available charitable funds. Any balance available after the operations-related contributions would be divided among various charitable interests of the two of us, on a basis roughly proportional to our ownership interest. If the manager of our company had some suggestions, we would listen carefully, but the final decision would be ours. Despite our corporate form, in this aspect of the business, we probably would behave as if we were a partnership. Wherever feasible, I believe in maintaining such a partnership frame of mind, even though we operate through a large, fairly widely held corporation. Our Treasury ruling will allow such partnership-like behavior in this area. I am pleased that Berkshire donations can become owner-directed. It is ironic but understandable that a large and growing number of major corporations have charitable policies pursuant to which they will match gifts made by their employees, and, as noted above, many even match gifts made by directors, but none, to my knowledge, has a plan matching charitable gifts by owners. I say understandable because much of the stock of many large corporations is owned on a revolving door basis by institutions that have short-term investment horizons and that lack a long-term owner's perspective. Our own shareholders are a different breed. At the end of each year, more than 98% of our shares are owned by people who were shareholders at the beginning of the year. This long-term commitment to the business reflects an owner mentality which, as your manager, I intend to acknowledge in all feasible ways. The designated contributions policy is an example of that intent. Our new program enabling shareholders to designate the recipients of corporate charitable contributions was greeted with extraordinary enthusiasm. Of 932,206 shares eligible for participation, shares where the name of the actual owner appeared on our stockholder record, 95.6% responded. Even excluding Buffett-related shares, the response topped 90%. In addition, more than 3% of our shareholders voluntarily wrote letters or notes, all but one approving of the program. Both the level of participation and of commentary surpass any shareholder response we have already witnessed, even when such response has been intensively solicited by corporate staff and highly paid professional proxy organizations. In contrast, your extraordinary level of response occurred without even the nudge of a company-provided return envelope. This self-propelled behavior speaks well for the program and speaks well for our shareholders. Apparently, the owners of our corporation like both possessing and exercising the ability to determine where gifts of their funds shall be made. The Father Knows Best school of corporate governance will be surprised to find that none of our shareholders sent in a designation sheet with instructions that the officers of Berkshire, in their superior wisdom, of course, make the decision on charitable funds applicable to his shares. Nor did anyone suggest that his share of our charitable funds be used to match contributions made by our corporate directors to charities of the directors' choice, a popular, proliferating, and non-publicized policy at many large corporations. All told, $1,783,655 of shareholder-designed contributions were distributed to about 675 charities. In addition, Berkshire and subsidiaries continue to make certain contributions pursuant to local-level decisions made by our operating managers. There will be some years, perhaps 2 or 3 out of 10, when contributions by Berkshire will produce substandard tax deductions or none at all. In those years, we will not affect our shareholder-designated charitable program. In all other years, we expect to inform you about October 10th of the amount per share that you may designate. A reply form will accompany the notice, and you will be given about 3 weeks to respond with your designation. The designated contributions idea, along with many other ideas that have turned out well for us, was conceived by Charlie Munger, Vice Chairman of Berkshire. Irrespective of titles, Charlie and I work as partners in managing all controlled companies. To almost a sinful degree, we enjoy our work as managing partners, and we enjoy having you as our financial partners. In addition to the shareholder-designated contributions that Berkshire distributes, managers of our operating businesses make contributions, including merchandise, averaging between $1.5 million and $2.5 million annually. These contributions support local charities, such as the United Way, and produce roughly commensurate benefits with our businesses. However, neither our operating managers nor officers of the parent company use Berkshire funds to make contributions to broad national programs or charitable activities of special personal interests to them, except to the extent they do so as shareholders. If your employees, including your CEO, wish to give to their alma maters or other institutions to which they feel a personal attachment, we believe they should use their own money, not yours. Let me add that our program is easy to administer. Last fall, for 2 months, we borrowed one person from National Indemnity to help us implement the instructions that came from our 7,500 registered shareholders. I'd guess that the average corporate program in which employee gifts are matched incurs far greater administrative costs. Indeed, our entire corporate overhead is less than half the size of our charitable contributions. Charlie, however, insists that I tell you that $1.4 million of our $4.9 million overhead is attributable to our corporate jet, the Indefensible. Below is a list showing the largest categories to which our shareholders have steered their contributions. A. 347 churches and synagogues received 569 gifts. B. 238 colleges and universities received 670 gifts. C. 244 K-12 schools, about 2/3 secular, 1/3 religious, received 525 gifts. D. 288 institutions dedicated to art, culture, or the humanities received 447 gifts. E. 180 religious social service organizations, split about equally between Christian and Jewish, received 411 gifts. F. 445 secular social service organizations, about 40% youth-related, received 759 gifts. G. 153 hospitals received 261 gifts. H. 186 health-related organizations, American Heart Association, American Cancer Society, etc., received 320 gifts. 3 things about this list seem particularly interesting to me. First, to some degree it indicates what people choose to give money to when they are acting of their own accord, free of pressure from solicitors or emotional appeals from charities. Second, the contributions programs of publicly held companies almost never allow gifts to churches and synagogues, yet clearly these institutions are what many shareholders would like to support. Third, the gifts made by our shareholders display conflicting philosophies. 130 gifts were directed to organizations that believe in making abortions readily available for women, and 30 gifts were directed to organizations other than churches that discourage or are opposed to abortion. Last year I told you that I was thinking of raising the amount that Berkshire shareholders can give under our designated contributions program and ask for your comments. We received a few well-written letters opposing the entire idea on the grounds that it was our job to run the business and not our job to force shareholders into making charitable gifts. Most of the shareholders responding, however, noted the tax efficiency of the plan and urged us to increase the designated amount. Several shareholders who have given stock to their children or grandchildren told me that they consider the program a particularly good way to get youngsters thinking at an early age about the subject of giving. These people, in other words, perceive the program to be an educational as well as philanthropic tool. The bottom line is that we did raise the amount in 1993 from $8 per share to $10. We reluctantly terminated the shareholder-designated contribution program in 2003 because of controversy over the abortion issue. Over the years, numerous organizations on both sides of this issue had been designated by our shareholders to receive contributions. As a result, we regularly received some objections to the gifts designated for pro-choice operations. A few of these came from people and organizations that proceeded to boycott products of our subsidiaries. In 2003, many independent associates of the Pampered Chef began to feel the boycotts. This development meant that people who trusted us, but who were neither employees of ours nor had a voice in Berkshire decision-making, suffered serious losses of income. For our shareholders, there was some modest tax efficiency in Berkshire doing the giving rather than making their gifts directly. Additionally, the program was consistent with our partnership approach. But these advantages paled when they were measured against damage done loyal associates who had, with great personal effort, built businesses of their own. Indeed, Charlie and I see nothing charitable in harming decent, hardworking people just so we and other shareholders can gain some minor tax efficiencies. Berkshire now makes no contributions at the parent company level. Our various subsidiaries follow philanthropic policies consistent with their practices prior to their acquisition by Berkshire, except that any personal contributions that former owners had earlier made from their corporate pocketbook are now funded by them personally. A principled approach to executive pay. When returns on capital are ordinary, and earn more by putting up more record is no great managerial achievement. You can get the same result personally while operating from your rocking chair. Just quadruple the capital you commit to a savings account and you will quadruple your earnings. You would hardly expect hosannas for that particular accomplishment. Yet retirement announcements regularly sing the praises of CEOs who have, say, quadrupled earnings of their widget company during their reign, with no one examining whether this gain was attributable simply to many years of retained earnings and the workings of compound interest. If the widget company consistently earned a superior return on capital throughout the period, or if capital employed only doubled this during the CEO's reign, the praise for him may be well deserved. But if return on capital was lackluster and capital employed increased in pace with earnings, applause should be withheld. A savings account in which interest was reinvested would achieve the same year-by-year increase in earnings and, at only 8% interest, would quadruple its annual earnings in 18 years. The power of this simple math is often ignored by companies to the detriment of their shareholders. Many corporate compensation plans reward managers handsomely for earnings increases produced solely or in large part by retained earnings, i.e., earnings withheld from owners. For example, 10-year fixed-price stock options are granted routinely, often by companies whose dividends are only a small percentage of earnings. An example will illustrate the inequities possible under such circumstances. Let's suppose that you had a $100,000 savings account earning 8% interest and managed by a trustee who could decide each year what portion of the interest you were to be paid in cash. Interest not paid out would be retained earnings, added to the savings account to compound. And let's suppose that your trustee in his superior wisdom set the payout ratio at 1/4 of the annual earnings. Under these assumptions, your account would be worth $179,000 at the end of 10 years. Additionally, your annual earnings would have increased about 70% from $8,000 to $13,515 under this inspired management. And finally, your dividends would have increased commensurately, rising regularly from $2,000 in the first year to $3,378 in the 10th year. Each year, when your manager's public relations firm prepared his annual report to you, all of the charts would have lines marching skyward. Now, just for fun, let's push our scenario one notch further and give your trustee manager a 10-year fixed price option on part of your business, i.e. your savings account, based on its fair value in the first year. With such an option, your manager would reap a substantial profit at your expense just from having held on to most of your earnings. If he were both Machiavellian and a bit of a mathematician, your manager might have also cut the payout ratio once he was firmly entrenched. This scenario is not as far-fetched as you might think. Many stock options in the corporate world have worked in exactly that fashion. They have gained in value simply because management retained earnings, not because it did well with the capital in its hands. Managers actually apply a double standard to options. Leaving aside warrants, which deliver the issuing corporation immediate and substantial compensation, I believe it is fair to say that nowhere in the business world are 10-year fixed-price options on all or a portion of a business granted to outsiders. 10 months, in fact, would be regarded as extreme. It would be particularly unthinkable for managers to grant a long-term option on a business that was regularly adding to its capital. Any outsider wanting to secure such an option would be required to pay fully for capital added during the option period. The unwillingness of managers to do unto outsiders, however, is not matched by an unwillingness to do unto themselves. Negotiating with one's self-wisdom produces a bathroom brawl. Managers regularly engineer 10-year fixed-price options for themselves and associates that, first, totally ignore the fact that retained earnings automatically build value, and second, ignore the carrying cost of capital. As a result, these managers end up profiting much as they would have had they had an option on that savings account that was automatically building up in value. Of course, stock options often go to talented, value-adding managers and sometimes deliver them rewards that are perfectly appropriate. Indeed, managers who are really exceptional almost always get far less than they should. But when the result is equitable, it is accidental. Once granted, the option is blind to individual performance. Because it is irrevocable and unconditional so long as the manager stays in the company, the sluggard receives rewards from his options precisely as does the star. A managerial Rip Van Winkle, ready to doze for 10 years, could not wish for a better incentive system. I can't resist commenting on one long-term option given an outsider, that granted U.S. government on Chrysler shares as partial consideration for the government's guarantee of some life-saving loans. When these options worked out well for the government, Chrysler sought to modify the payoff, arguing that the rewards to the government were both far greater than intended and outsized in relation to its contribution to Chrysler's recovery. The company's anguish over what it saw as an imbalance between payoff and performance made national news. That anguish may well be unique. To my knowledge, no managers anywhere have been similarly offended by unwarranted payoffs arising from options granted to themselves or their colleagues. Ironically, the rhetoric about options frequently describes them as desirable because they put managers and owners in the same financial boat. In reality, the boats are far different. No owner has ever escaped the burden of capital costs, whereas a holder of a fixed-price option bears no capital costs at all. An owner must weigh upside potential against downside risk. An option holder has no downside. In fact, the business project in which you would wish to have an option frequently is a project in which you would reject ownership. I'll be happy to accept a lottery ticket as a gift, but I'll never buy one. In dividend policy also, the option holders' interests are best served by a policy that may ill-serve the owner. Think back to the savings account example. The trustee holding his option would benefit from a no-dividend policy. Conversely, the owner of the account should lean to a total payout so that he can prevent the option-holding manager from sharing in the account's retained earnings. Despite their shortcomings, options can be appropriate under some circumstances. My criticism relates to their indiscriminate use, and, in that connection, I would like to emphasize 3 points. First, stock options are inevitably tied to the overall performance of a corporation. Logically, therefore, they should be awarded only to those managers with overall responsibility. Managers with limited areas of responsibility should have incentives that pay off in relation to results under their control. The .350 hitter expects and also deserves a big payoff for his performance, even if he plays for a cellar-dwelling team. And the .150 hitter should get no reward, even if he plays for a pennant winner. Only those with overall responsibility for the team should have the rewards tied to results. Second, options should be structured carefully. Absent special factors, they should have built into them a retained earnings or carrying cost factor. Equally important, they should be priced realistically. When managers are faced with offers for their companies, they unfailingly point out how unrealistic market prices can be as an index of real value. But why, then, should these same depressed prices be the valuations at which managers sell portions of their businesses to themselves? They may go further. Officers and directors sometimes consult the tax code to determine the lowest prices at which they can, in effect, sell part of the business to insiders. While they're at it, they often elect plans that produce the worst tax result for the company. Except in highly unusual cases, owners are not well served by the sale of part of their business at a bargain price, whether the sale is to outsiders or to insiders. The obvious conclusion, options should be priced at true business value. Third, I want to emphasize that some managers whom I admire enormously and whose operating records are far better than mine disagree with me regarding fixed-price options. They have built corporate cultures that work, and fixed-price options have been a tool that helps them. By their leadership and example, and by use of the options as incentives, these managers have taught their colleagues to think like owners. Such a culture is rare, and when it exists should perhaps be left intact, despite inefficiencies and inequities that may infest the option program. If it ain't broke, don't fix it is preferable to purity at any price. Take, for instance, 10-year fixed-price options, and who wouldn't? If Fred Futile, CEO of Stagnant Inc., receives a bundle of these, let's say enough to give him an option on 1% of the company, his self-interest is clear. He should skip dividends entirely and instead use all of the company's earnings to repurchase stock. Let's assume that under Fred's leadership, Stagnant lives up to its name. In each of the 10 years after the option grant, it earns $1 billion on $10 billion of net worth, which initially comes to $10 per share on the 100 million shares then outstanding. Fred eschews dividends and regularly uses all earnings to repurchase shares. If the stock constantly sells at 10 times earnings per share, it will have appreciated 158% by the end of the option period. That's because repurchases would reduce the number of shares to 38.7 million by that time, and earnings per share would thereby increase to $25.80. Simply by withholding earnings from owners, Fred gets very rich, making a cool $158 million, despite the business itself improving not at all. Astonishingly, Fred could have made more than $100 million if Stagnant's earnings had declined by 20% during the 10-year period. Fred can also get a splendid result for himself by paying no dividends and deploying the earnings he withholds from shareholders into a variety of disappointing projects and acquisitions. Even if these initiatives deliver a paltry 5% return, Fred will still make a bundle. Specifically, with Stagnant's PE ratio remaining unchanged at 10, Fred's option will deliver him $63 million. Meanwhile, his shareholders will wonder what happened to the alignment of interests that was supposed to occur when Fred was issued options. A normal dividend policy, of course, 1/3 of earnings paid out, for example, produces less extreme results but still can provide lush rewards for managers who achieve nothing. CEOs understand this math and know that every dime paid out in dividends reduces the value of all not outstanding options. I've never, however, seen this manager-owner conflict referenced in proxy materials that request approval of a fixed-price option plan. Though CEOs invariably preach internally that capital comes at a cost, they somehow forget to tell shareholders that fixed-price options give them capital that is free. It doesn't have to be this way. It's child's play for a board to design options that give effect to the automatic buildup in value that occurs when earnings are retained. But, surprise, surprise, options of that kind are almost never issued. Indeed, the very thought of options with strike prices that are adjusted for retained earnings seems foreign to compensation experts, who are nevertheless encyclopedic about every management-friendly plan that exists. Whose bread I eat, his song I sing. Getting fired can produce a particularly bountiful payday for a CEO. Indeed, he can earn more in that single day while cleaning out his desk than an American worker earns in a lifetime of cleaning toilets. Forget the old maxim about nothing succeeding like success. Today, in the executive suite, the all-too-prevalent rule is that nothing succeeds like failure. At Berkshire, however, we use an incentive compensation system that rewards key managers for meeting targets in their own bailiwicks. If C's Candies does well, that does not produce incentive compensation at the news, nor vice versa. Neither do we look at the price of Berkshire stock when we write bonus checks. We believe good unit performance should be rewarded whether Berkshire stock rises, falls, or stays even. Similarly, we think average performance should earn no special rewards even if our stock should soar. Performance, furthermore, is defined in different ways depending upon the underlying economics of the business. In some, our managers enjoy tailwinds not of their own making. In others, they fight unavoidable headwinds. The rewards that go with the system can be large. At our various business units, top managers sometimes receive incentive bonuses of 5 times their base salary or more, and it would appear possible that one manager's bonus could top $2 million in 1986. I hope so. We do not put a cap on bonuses, and the potential for rewards is not hierarchical. The manager of a relatively small unit can earn far more than the manager of a larger unit if results indicate he should. We believe, further, that such factors as seniority and age should not affect incentive compensation, though they sometimes influence basic compensation. A 20-year-old who can hit .300 is as valuable to us as a 40-year-old performing as well. Obviously, all Berkshire managers can use their bonus money or other funds, including borrowed money, to buy our stock in the market. Many have done just that, and some now have large holdings. By accepting both the risks and the carrying costs that go with outright purchases, these managers truly walk in the shoes of owners. At Berkshire, we try to be as logical about compensation as about capital allocation. For example, we compensate Ralph Sachet based upon the results of Scott Fetzer rather than those of Berkshire. What could make more sense, since he's responsible for one operation but not the other? A cash bonus or a stock option tied to the fortunes of Berkshire would provide totally capricious rewards to Ralph. He could, for example, be hitting home runs at Scott Fetzer while Charlie and I ring up mistakes at Berkshire, thereby negating his efforts many times over. Conversely, why should options, profits, or bonuses be heaped upon Ralph if good things are occurring in other parts of Berkshire but Scott Fetzer is lagging? In setting compensation, we like to hold out the promises of large carrots, but make sure their delivery is tied directly to results in the area that a manager controls. When capital invested in an operation is significant, we also both charge managers a high rate for incremental capital they employ and credit them at an equally high rate for capital they release. The product of this money's not free approach is definitely visible at Scott Fetzer. If Ralph can employ incremental funds at good returns, it pays him to do so. His bonus increases when earnings on additional capital exceed a meaningful hurdle charge. But our bonus calculation is symmetrical. If incremental investment yields substandard returns, the shortfall is costly to Ralph as well as to Berkshire. The consequence of this two-way arrangement is that it pays Ralph, and pays him well, to send to Omaha any cash he can't advantageously use in his businesses. It has become fashionable at public companies to describe almost every compensation plan as aligning the interests of management with those of shareholders. In our book, alignment means being a partner in both directions, not just on the upside. Many alignment plans flunk this basic test, being artful forms of heads I win, tails you lose. A common form of misalignment occurs in the typical stock option arrangement, which does not periodically increase the option price to compensate for the fact that retained earnings are building up the wealth of the company. Indeed, the combination of a 10-year option, a low dividend payout, and compound interest can provide lush gains to a manager who has done no more than tread water in his job. A cynic might even note that when payments to owners are held down, the profit to the option-holding manager increases. I have yet to see this vital point spelled out in a proxy statement asking shareholders to approve an option plan. I can't resist mentioning that our compensation arrangement with Ralph Sachet has worked out in about 5 minutes, immediately upon our purchase of Scott Fetcher and without the help of lawyers or compensation consultants. This arrangement embodies a very few simple ideas, not the kind of terms favored by consultants who cannot easily send a large bill unless they have established that you know of a large problem, and one, of course, that requires an annual review. Our agreement with Ralph has never been changed. It made sense to him and to me in 1986, and it makes sense now. Our compensation arrangements with the managers of all our other units are similarly simple, though the terms of each agreement vary to fit the economic characteristics of the business at the issue, the existence in some cases of partial ownership of the unit by managers, etc. In all instances, we pursue rationality. Arrangements that pay off in capricious ways unrelated to a manager's personal accomplishments may well be welcomed by certain managers. Who, after all, refuses a free lottery ticket? But such arrangements are wasteful to the company and cause the manager to lose focus on what should be his real areas of concern. Additionally, irrational behavior at the parent may well encourage imitative behavior at subsidiaries. At Berkshire, only Charlie and I have the managerial responsibility for the entire business. Therefore, we are the only parties who should logically be compensated on the basis of what the enterprise does as a whole. Even so, that is not a compensation arrangement we desire. We have carefully designed both the company and our jobs so that we do things we enjoy with people we like. Equally important, we are forced to do very few boring or unpleasant tasks. We are the beneficiaries as well of the abundant array of material and psychic perks that flow to the heads of corporations. Under such idyllic conditions, we don't expect shareholders to ante up loads of compensation for which we have no possible need. Indeed, if we were not paid at all, Charlie and I would be delighted with the cushy jobs we hold. At bottom, we subscribe to Ronald Reagan's creed, "It's probably true that hard work never killed anyone, but I figure why take the chance." We made a sizable acquisition in 1991, the H. Brown Shoe Company, the leading North American manufacturer of work shoes and boots, and it has a history of earning unusually fine margins on sales and assets. Shoes are a tough business. Of the billion pairs purchased in the United States each year, about 85% are imported, and most manufacturers in the industry do poorly. The wide range of styles and sizes that producers offer causes inventories to be heavy. Substantial capital is also tied up in receivables. A distinguishing characteristic of H. Brown is one of the most unusual compensation systems I've encountered, but one that warms my heart. A number of key managers are paid in an annual salary of $7,800, to which is added a designated percentage of the profits of the company after these are reduced by a charge for capital employed. These managers, therefore, truly stand in the shoes of owners. In contrast, most managers talk the talk but don't walk the walk, choosing instead to employ compensation systems that are long on carrots but short on sticks, and that almost invariably treat equity capital as if it were cost-free. The arrangement at Brown, in any case, has served both the company and its managers exceptionally well, which should be no surprise. Managers eager to bet heavily on their abilities usually have plenty of ability to bet on. It's understandable how CEO pay got out of hand. When management hires employees or when companies bargain with a vendor, the intensity of interest is equal on both sides of the table. One party's gain is the other party's loss, and the money involved has real meaning to both. The result is an honest-to-God negotiation. But when CEOs or their representatives have met with compensation committees, too often one side, the CEO's, has cared far more than the other about what bargain is struck. A CEO, for example, will always regard the difference between receiving options for 100,000 shares or for 500,000 as monumental. To a comp committee, however, the difference may seem unimportant, particularly if, as has been the case at most companies, neither grant will have any effect on reported earnings. Under these conditions, the negotiation often has a play money quality. Overreaching by CEOs greatly accelerated in the 1990s as compensation packages gained by the most avaricious, a title for which there was vigorous competition, were promptly replicated elsewhere. The couriers for this epidemic of greed were usually consultants and human relations departments, which had no trouble perceiving who buttered their bread. As one compensation consultant commented, there are two classes of clients you don't want to offend: actual and potential. In recent years, compensation committees too often have been tail-wagging puppy dogs meekly following recommendations by consultants, a breed not known for allegiance to the faceless shareholders who pay their fees. If you can't tell whose side someone is on, they're not on yours. True, each committee is required by the SEC to state its reasoning about pay in the proxy, but the words are usually boilerplate written by the company's lawyers or its human relations department. This costly charade should cease. Directors should not serve on compensation committees unless they are themselves capable of negotiating on behalf of owners. They should explain both how they think about pay and how they measure performance. Dealing with shareholders as money, moreover, they should behave as they would were it their own. In the 1890s, Samuel Gompers described the goal of organized labor as more. In the 1990s, America's CEOs adopted his battle cry. The upshot is that CEOs have often amassed riches while their shareholders have experienced financial disasters. Directors should stop such piracy. There's nothing wrong with paying well for truly exceptional business performance, but for anything short of that, it's time for directors to shout less. It would be a travesty if the bloated pay of recent years became a baseline for future compensation. Compensation committees should go back to the drawing boards. Risk, reputation, and oversight. Charlie and I believe that a CEO must not delegate risk control. It's simply too important. At Berkshire, for example, I both initiate and monitor every derivatives contract on our books, with the exception of operations-related contracts at a few of our subsidiaries, such as Mid-American and the minor runoff contracts at General Re. If Berkshire ever gets in trouble, it will be my fault. It will not be because of misjudgments made by a risk committee or chief risk officer. In my view, a board of directors of a huge financial institution is derelict if it does not insist that its CEO bear full responsibility for risk control. If he's incapable of handling that job, he should look for other employment. And if he fails at it, with the government thereupon required to step in with funds or guarantees, the financial consequences for him and his board should be severe. It has not been shareholders who have botched the operations of some of our country's largest financial institutions, yet they have borne the burden, with 90% or more of the value of their holdings wiped out in most cases of failure. Collectively, they have lost more than $500 billion in just the four largest financial fiascos of the last 2 years. To say these owners have been bailed out is to make a mockery of the term. The CEOs and directors of the failed companies, however, have largely gone unscathed. Their fortunes may have been diminished by the disasters they oversaw, but they still live in grand style. It is the behavior of these CEOs and directors that needs to be changed. If their institutions and the country are harmed by their recklessness, they should pay a heavy price, one not reimbursable by the companies they've damaged nor by insurance. CEOs, and in many cases directors, have long benefited from oversized financial carrots. Some meaningful sticks now need to be part of their employment picture as well. The 2010 annual report included the following dated July 26, 2010 to Berkshire's managers. This is my biennial letter to reemphasize Berkshire's top priority, which is that all of us continue to zealously guard Berkshire's reputation. We can't be perfect, but we can try to be. As I've said in these memos for more than 25 years, we can afford to lose money, even a lot of money, but we can't afford to lose reputation, even a shred of reputation. We must continue to measure every act against not only what is legal, but also what we would be happy to have written about on the front page of a national newspaper in an article written by an unfriendly but intelligent reporter. Sometimes your associates will say, everybody else is doing it. This rationale is almost always a bad one if it is the main justification for a business action. It is totally unacceptable when evaluating a moral decision. Whenever somebody offers that phrase as a rationale, in effect they are saying that they can't come up with a good reason. If anyone gives this explanation, tell them to try using it with a reporter or a judge to see how far it gets them. If you see anything whose propriety or legality causes you to hesitate, be sure to give me a call. However, it's very likely that if a given course of action evokes such hesitation, it's too close to the line and should be abandoned. There's plenty of money to be made in the center of the court. If it's questionable whether some action is close to the line, just assume it is outside and forget it. As a corollary, let me know promptly if there's any significant bad news. I can handle bad news, but I don't like to deal with it after it has festered for a while. A reluctance to face up immediately to bad news is what turned a problem at Solomon from one that could have been easily disposed of into one that almost caused the demise of a firm with 8,000 employees. Somebody is doing something today at Berkshire that you and I would be unhappy about if we knew of it. That's inevitable. We now employ more than 250,000 people, and the chances of that number getting through the day without any bad behavior occurring is nil. But we can have a huge effect in minimizing such activities by jumping on anything immediately when there is the slightest odor of impropriety. Your attitude on such manners, expressed by behavior as well as words, will be the most important factor in how the culture of your business develops. Culture, more than rule books, determines how an organization behaves. In other aspects, talk to me about what is going on as little or as much as you wish. Each of you does a first-class job of running your operation with your own individual style, and you don't need me to help. The only items you need to clear with me are any changes in post-retirement benefits and any unusually large capital expenditures or acquisitions. Audit committees can't audit. Only a company's outside auditor can determine whether the earnings that a management purports to have made are suspect. Reports that ignore this reality and that instead focus on the structure and charter of the audit committee will accomplish little. The key job of the audit committee is simply to get the auditors to divulge what they know. To do this job, the committee must make sure that the auditors worry more about misleading its members than about offending management. In recent years, auditors have not felt that way. They have instead generally viewed the CEO rather than the shareholders or directors as their client. That has been a natural result of day-to-day working relationships and also of the auditors understanding that, no matter what the book says, the CEO and CFO pay their fees and determine whether they are retained for both auditing and others' work. Rules in 2002's Sarbanes-Oxley Act requiring board audit committees to oversee auditors and set their pay won't materially change this reality. What will break this cozy relationship is audit committees unequivocally putting auditors on the spot, making them understand they will become liable for major monetary penalties if they don't come forth with what they know or suspect. In my opinion, audit committees can accomplish this goal by asking 4 questions of auditors, the answers to which should be recorded and reported to shareholders. These questions are: 1. If the auditor were solely responsible for preparation of the company's financial statements, would they have in any way been prepared differently from the manner selected by management? This question should cover both material and non-material differences. If the auditor would have done something differently, both management's argument and the auditor's response should be disclosed. The audit committee should then evaluate the facts. 2. If the auditor were an investor, would he have received, in plain English, the information essential to his understanding the company's financial performance during the reporting period? 3. Is the company following the same internal audit procedure that would be followed if the auditor himself were CEO? If not, what are the differences and why? 4. Is the auditor aware of any actions, either accounting or operational, that have had the purpose and effect of moving revenues or expenses from one reporting to another? If the audit committee asks these questions, its composition, the focus of most reforms, is of minor importance. In addition, the procedure will save time and expense. When auditors are put on the spot, they will do their duty. If they are not put on the spot, well, we have seen the results of that. The primary advantage of our 4 questions is that they will act as a prophylactic. Once the auditors know that the audit committee will require them to affirmatively endorse rather than merely acquiesce to managers' actions, they will resist misdoings early in the process, well before specious figures become embedded in the company's books. Fear of the plaintiff's bar will see to that. Corporate culture. Our flexibility in respect to capital allocation has accounted for much of our progress to date. We have been able to take money we earn from, say, See's Candies or Business Wire, 2 of our best-run businesses, but also 2 offering limited reinvestment opportunities, and use it as part of the stake we need to buy BNSF. Another advantage is the hard-to-duplicate culture that permeates Berkshire, and in businesses' culture accounts. To start with, the directors who represent you think and act like owners. This same owner orientation prevails among our managers. In many cases, these are people who have sought out Berkshire as an acquirer for a business that they and their families have long owned. They came to us with an owner's mindset, and we provide an environment that encourages them to retain it. Having managers who love their businesses is no small advantage. Cultures self-propagate. Bureaucratic procedures beget more bureaucracy, and imperial corporate palaces induce imperious behavior. As one wag put it, you know you're no longer CEO when you get in the backseat of your car and it doesn't move. At Berkshire's world headquarters, our annual rent is $270,212. Moreover, the home office investment in furniture, art, Coke dispenser, lunchroom, high-tech equipment, you name it, totals $301,363. As long as Charlie and I treat your money as if it were our own, Berkshire's managers are likely to be careful with it as well. Our compensation programs, our annual meeting, and even our annual reports are all designed with an eye to reinforcing the Berkshire culture and making it one that will repel and expel managers of a different bent. This culture grows stronger every year, and it will remain intact long after Charlie and I have left the scene. Finance and investing. We bought substantial Washington Post Company, WPC, holdings in mid-1973 at a price of not more than 1/4 of the then per-share business value of the enterprise. Calculating the price-to-value ratio required no unusual insights. Most security analysts, media brokers, and media executives would have estimated WPC's intrinsic business value at $400 million to $500 million, just as we did. And its $100 million stock market valuation was published daily for all to see. Our advantage, rather, was attitude. We had learned from Ben Graham that the key to successful investing was the purchase of shares in good businesses when market prices were at a large discount from underlying business values. Most institutional investors in the early 1970s, on the other hand, regarded business value as of only minor relevance when they were deciding the prices at which they would buy or sell. This now seems hard to believe. However, these institutions were then under the spell of academics at prestigious business schools who were preaching a newly fashioned theory. The stock market was totally efficient, and therefore calculations of business value and even thought itself were of no importance in business activities. We are enormously indebted to those academics. What could be more advantageous in an intellectual contest, whether it be bridge, chess, or stock selection, than to have opponents who have been taught that thinking is a waste of energy? Farms, real estate, and stock. From 1973 to 1981, the Midwest experienced an explosion in farm prices caused by a widespread belief that runaway inflation was coming and fueled by the lending policies of small rural banks. Then the bubble burst, bringing price declines of 50% or more that devastated both leveraged farmers and their lenders. 5 times as many Iowa and Nebraska banks failed in that bubble's aftermath than the Great Recession of 2008 to 2009. In 1986, I purchased a 400-acre farm located 50 miles north of Omaha from the FDIC. It cost me $280,000, considerably less than what a failed bank had lent against the farm a few years earlier. I knew nothing about operating a farm, but I have a son who loves farming, and I learned from him both how many bushels of corn and soybeans the farm would produce and what the operating expenses would be. From these estimates, I calculated the normalized return from the farm to be then about 10%. I also thought it was likely that productivity would improve over time and that crop prices would move higher as well. Both expectations proved out. I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside. There would, of course, be the occasional bad crop and prices would sometimes disappoint. But so what? There would be some unusually good years as well, and I would never be under any pressure to sell the property. Now, 3 decades later, the farm has tripled its earnings and is worth 5 times or more what I paid. I still know nothing about farming and recently made just my second visit to the farm. In 1993, I made another small investment, Larry Silverstein, Solomon's landlord, when I was the company's CEO, told me about a New York retail property adjacent to NYU that the Resolution Trust Corp was selling. Again, a bubble had popped, this one involving commercial real estate, and the RTC had been created to dispose of the assets of failed savings institutions whose optimistic lending practices had fueled the folly. Here, too, the analysis was simple. As had been the case with the farm, the unleveraged current yield from the property was about 10%, but the property had been undermanaged by the RTC, and its income would increase when several vacant stores were leased. Even more important, the largest tenant, who occupied about 20% of the project's space, was paying rent of about $5 per foot, whereas other tenants averaged $70. The expiration of this bargain lease in 9 years was certain to provide a major boost to earnings. The property's location was also superb. NYU wasn't going anywhere. I joined a small group, including Larry and my friend Fred Rose, that purchased the parcel. Fred was an experienced, high-grade real estate investor who, with his family, would manage the property, and manage it they did. As old leases expired, earnings tripled. Annual distributions now exceed 30% of our original equity investment. Moreover, our original mortgage was refinanced in 1996 and again in 1999, moves that allowed several special distributions totaling more than 150% of what we had invested. I've yet to view the property. Income from both the farm and the NYU real estate will probably increase in the decades to come. Though the gains won't be dramatic, the two investments will be solid and satisfactory holdings for my lifetime and, subsequently, for my children and grandchildren. I tell these tales to illustrate certain fundamentals of investing. You don't need to be an expert in order to achieve satisfactory investment returns. But if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Focus on the future productivity of the asset you are considering. If you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. No one has the ability to evaluate every investment possibility. But omniscience isn't necessary. You only need to understand the actions you undertake. If you instead focus on the prospective price change of a contemplated purchase, you are speculating. There is nothing improper about that. I know, however, that I am unable to speculate successfully, and I am skeptical of those who claim sustained success at doing so. Half of all coin flippers will win their first toss. None of those winners has an expectation of profit if he continues to play the game. And the fact that a given asset has appreciated in the recent past is never a reason to buy it. With my two small investments, I thought only of what the properties would produce and cared not at all about their daily valuations. Games are won by players who focus on the playing field, not by those whose eyes are glued to the scoreboard. If you can enjoy Saturdays and Sundays without looking at stock prices, give it a try on weekdays. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I am reminded of Mickey Mantle's scathing comment, "You don't know how easy this game is until you get into that broadcasting booth." My two purchases were made in 1986 and 1983. What the economy, interest rates, or the stock market might do in the years immediately following 1987 and 1994 was of no importance to me in making those investments. I can't remember what the headlines or pundits were saying at the time. Whatever the chatter, corn would keep growing in Nebraska and students would flock to NYU. There is one major difference between my two small investments and an investment in stocks. Stocks provide you with minute-to-minute valuations for your holdings, whereas I have yet to see a quotation for either my farm or the New York real estate. It should be an enormous advantage for investors in stocks to have those wildly fluctuating valuations placed on their holdings, and for some investors it is. After all, if a moody fellow with a farm bordering my property yelled out a price every day to me at which he would either buy my farm or sell me his, and those prices varied widely over short periods of time depending on his mental state, how in the world could I be other than benefited by his erratic behavior? If his daily shout-out was ridiculously low and I had some spare cash, I would buy his farm. If the number he yelled was absurdly high, I could either sell to him or just go on farming. Owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners cause them to behave irrationally as well. Because there is so much chatter about markets, the economy, interest rates, price behavior of stocks, etc., some investors believe it is important to listen to pundits and, worse yet, important to consider acting upon their comments. Those people who can sit quietly for decades when they own a farm or apartment house too often become frenetic when they are exposed to a stream of stock quotations and accompanying commentators delivering an implied message of "don't just sit there, do something." For these investors, liquidity is transformed from the unqualified benefit it should be to a curse. A flash crash or some other extreme market fluctuation can't hurt an investor any more than an erratic and mouthy neighbor can hurt my farm investment. Indeed, tumbling markets can be helpful to the true investor if he has cash available when prices get far out of line with values. A climate of fear is your friend when investing. A euphoric world is your enemy. During the extraordinary financial panic that occurred late in 2008, I never gave a thought to selling my farm or New York real estate, even though a severe recession was clearly brewing. And if I had owned 100% of a solid business with good long-term prospects, it would have been foolish for me to even consider dumping it. So why would I have sold my stocks that were small participations in wonderful businesses? True, any of them might have eventually disappointed, but as a group they were certainly to do well. Could anyone really believe the earth was going to swallow up the incredible productive assets and unlimited human ingenuity existing in America? When Charlie and I buy stocks, which we think of as small portions of businesses, our analysis is very similar to that which we use in buying entire businesses. We first have to decide whether we can sensibly estimate an earnings range for 5 years out or more. If the answer is yes, we will buy the stock or business if it sells at a reasonable price in relation to the bottom boundary of our estimate. If, however, we lack the ability to estimate future earnings, which is usually the case, we simply move on to other prospects. In the 54 years we have worked together, we have never foregone an attractive purchase because of the macro or political environment or the views of other people. In fact, these subjects never come up when we make decisions. Mr. Market. Whenever Charlie and I buy common stocks for Berkshire's insurance companies, leaving aside arbitrage purchases discussed in the next essay, we approach the transaction as if we were buying into a private business. We look at the economic prospects of the business, the people in charge of running it, and the price we must pay. We do not have in mind any time or price for sale. Indeed, we are willing to hold a stock indefinitely so long as we expect the business to increase in intrinsic value at a satisfactory rate. When investing, we view ourselves as business analysts, not as market analysts, not as macroeconomic analysts, and not even as security analysts. Our approach makes an active trading market useful since it periodically presents us with mouth-watering opportunities. But by no means is it essential. A prolonged suspension of trading in the securities we hold would not bother us any more than does the lack of daily quotations on World Book or Feckheimer. Eventually, our economic fate will be determined by the economic fate of the business we own, whether our ownership is partial or total. Ben Graham, my friend and teacher, long ago described the mental attitude toward the market fluctuations that I believe to be most conducive to investment success. He said that you should imagine market quotations as coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business. Without fail, Mr. Market appears daily and names a price at which he will either buy your interest or sell you his. Even though the business that the two of you own may have economic characteristics that are stable, Mr. Market's quotations will be anything but. For, sad to say, the poor fellow has incurable emotional problems. At times he feels euphoric and can see only the favorable factors affecting the business. When in that mood, he names a very high buy-sell price because he fears that you will snap up his interest and rob him of imminent gains. At other times, he is depressed and can see nothing but trouble ahead for both the business and the world. On these occasions, he will name a very low price, since he is terrified that you will unload your interest on him. Mr. Market has another endearing characteristic. He doesn't mind being ignored. If this quotation is uninteresting to you today, he will be back by tomorrow with a new one. Transactions are strictly at your opinion. Under these conditions, the more manic-depressive his behavior, the better for you. But, like Cinderella at the ball, you must heed one warning or everything will turn into pumpkins and mice. Mr. Market is there to serve you, not to guide you. It is his pocketbook, not his wisdom, that you will find useful. If he shows up someday in a particularly foolish mood, you are free to either ignore him or to take advantage of him, but it will be disastrous if you fall under his influence. Indeed, if you aren't certain that you understand and can value your business far better than Mr. Market, you don't belong in the game. As they say in poker, if you've been in the game 30 minutes and you don't know who the patsy is, you're the patsy. Ben's Mr. Market allegory may seem out of date in today's investment world, in which most professionals and academicians talk of efficient markets, dynamic hedging, and betas. Their interest in such matters is understandable, since techniques shrouded in mystery clearly have value to the purveyor of investment advice. After all, what witch doctor has ever achieved fame and fortune by simply advising, take 2 aspirins? The value of market esoterica to the consumer of investment advice is a different story. In my opinion, investment success will not be produced by arcane formulae, computer programs, or signals flashed by the price behavior of stocks and markets. Rather, an investor will succeed by coupling good business judgment with an ability to insulate his thoughts and behavior from the super contagious emotions that swirl about the marketplace. In my own efforts to stay insulated, I have found it highly useful to keep Ben's Mr. Market concept firmly in mind. Following Ben's teachings, Charlie and I let our marketable equities tell us by their operating results, not by their daily or even yearly price quotations, whether our investments are successful. The market may ignore business success for a while, but eventually will confirm it. As Ben said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price. Sometimes, of course, the market may judge a business to be more valuable than the underlying facts would indicate it is. In such a case, we will sell our holdings. Sometimes also we will sell a security that is fairly valued or even undervalued because we require funds for a still more undervalued investment or one we believe we understand better. We need to emphasize, however, that we do not sell holdings just because they have appreciated or because we have held them for a long time. Of Wall Street maxims, the most foolish may be, you can't go broke taking a profit. We are quite content to hold any security indefinitely, so long as the prospective return on equity capital of the underlying business is satisfactory, management is competent and honest, and the market does not overvalue the business. However, our insurance companies own some marketable common stocks that we would not sell even though they became far overpriced in the market. In effect, we view these investments exactly like our successful controlled businesses, a permanent part of Berkshire rather than merchandise to be disposed of once Mr. Market offers us a sufficiently high price. To that, I will add one qualifier. These stocks are held by our insurance companies, and we would, if absolutely necessary, sell portions of our holdings to pay extraordinary insurance losses. We intend, however, to manage our affairs so that sales are never required. A determination to have and to hold, which Charlie and I share, obviously involves a mixture of personal and financial considerations. To some, our stand may seem highly eccentric. Charlie and I have long followed David Ogilvy's advice, develop your eccentricities while you are young. That way, when you get old, people won't think you're going gaga. Certainly, in the transaction-fixated Wall Street of recent years, our posture must seem odd. To many in that arena, both companies and stocks are seen only as raw material for trades. Our attitude, however, fits our personalities and the way we want to live our lives. Churchill once said, "You shape your houses and then they shape you." We know the manner in which we wish to be shaped. For that reason, we would rather achieve a return of X while associating with people whom we strongly like and admire than realize 110% of X by exchanging these relationships for uninteresting or unpleasant ones. A short quiz. If you plan to eat hamburgers throughout your life and are not a cattle producer, should you wish for higher or lower prices for beef? Likewise, if you are going to buy a car from time to time but are not an auto manufacturer, should you prefer higher or lower car prices? These questions, of course, answer themselves. But now for the final exam. If you expect to be a net saver during the next 5 years, should you hope for a higher or lower stock market during that period? Many investors get this one wrong. Even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. In effect, they rejoice because prices have risen for the hamburgers they will soon be buying. This reaction makes no sense. Only those who will be sellers of equities in the near future should be happy at seeing stocks rise. Prospective purchasers should much prefer sinking prices. For shareholders of Berkshire who do not expect to sell, the choice is even clearer. To begin with, our owners are automatically saving even if they spend every dime they personally earn. Berkshire saves for them by retaining all earnings, thereafter using these savings to purchase businesses and securities. Clearly, the more cheaply we make these buys, the more profitable our owners' indirect savings program will be. Furthermore, through Berkshire, you own a major position in companies that consistently repurchase their shares. The benefits that these programs supply us grow as prices fall. When stock prices are low, the funds that an investee spends on repurchases increase our ownership for that company by a greater amount than is the case when prices are higher. For example, the repurchases that Coca-Cola and Wells Fargo made in past years at very low prices benefited Berkshire far more than do today's repurchases made at loftier prices. Since at the end of every year, almost all Berkshire shares are held by the same investors who owned them at the start of the year, Berkshire shareholders are savers. They should therefore rejoice when markets decline and allow both us and our investees to deploy funds more advantageously. So smile when you read a headline that says, "Investors lose as market falls." Edit it in your mind to, "Disinvestors lose as market falls, but investors gain." Though writers often forget this truism, there is a buyer for every seller, and what hurts one necessarily helps the other. As they say in golf matches, every putt makes someone happy. We gained enormously from the low prices placed on many equities and businesses in the 1970s and 80s. Markets that then were hostile to investment transients were friendly to those taking up permanent residence. In recent years, the actions we took in those decades have been validated, but we have found few new opportunities. In its role as a corporate saver, Berkshire continually looks for ways to sensibly deploy capital, but it may be some time before we find opportunities that get us truly excited. Arbitrage. Our insurance subsidiaries sometimes engage in arbitrage as an alternative to holding short-term cash equivalents. We prefer, of course, to make major long-term commitments, but we often have more cash than good ideas. At such times, arbitrage sometimes promises much greater returns than treasury bills and, equally important, cools any temptation we may have to relax our standards for long-term investments. Charlie's sign-off after we've talked about an arbitrage commitment is usually, "Okay, at least it will keep you out of bars." During 1988, we made unusually large profits from arbitrage, measured both by absolute dollars and rate of return. Our pre-tax gain was about $78 million on average invested funds of about $147 million. This level of activity makes some detailed discussion of arbitrage and our approach to it appropriate. Once, the word applied only to the simultaneous purchase and sale of securities or foreign exchange in two different markets. The goal was to exploit tiny price differentials that might exist between, say, Royal Dutch stock trading in guilders in Amsterdam, pounds in London, and dollars in New York. Some people might call this scalping. It won't surprise you that practitioners opted for the French term arbitrage. Since World War I, the definition of arbitrage, or risk arbitrage, as it is now sometimes called, has expanded to include the pursuit of profits from an announced corporate event such as sale of the company, merger, recapitalization, reorganization, liquidation, self-tender, etc. In most cases, the arbitrageur expects to profit regardless of the behavior of the stock market. The major risk he usually faces instead is that the announced event won't happen. Some offbeat opportunities occasionally arise in the arbitrage field. I participated in one of these when I was 24 and working in New York for Graham Newman Corp. Rockwood and Company, a Brooklyn-based chocolate products company of limited profitability, had adopted LIFO inventory valuation in 1941 when cocoa was selling for 5 cents per pound. In 1954, a temporary shortage of cocoa caused the price to soar to over 60 cents. Consequently, Rockwood wished to unload its valuable inventory quickly before the price dropped. But if the cocoa had simply been sold off, the company would have owed close to a 50% tax on the proceeds. The 1954 tax code came to the rescue. It contained an arcane provision that eliminated the tax otherwise due on LIFO profits if inventory was distributed to shareholders as part of a plan reducing the scope of a corporation's business. Rockwood decided to terminate one of its business, the sale of cocoa butter, and said 13 million pounds of its cocoa bean inventory was attributable to that activity. Accordingly, the company offered to repurchase its stock in exchange for the cocoa beans it no longer needed, paying 80 pounds of beans for each share. For several weeks, I busily bought shares, sold beans, and made periodic stops at Schroeder Trust to exchange stock certificates for warehouse receipts. The profits were good, and my only expense was subway tokens. The architect of Rockwood's restructuring was an unknown but brilliant Chicagoan, Jay Pritzker, then 32. If you're familiar with Jay's subsequent record, you won't be surprised to hear the action worked out rather well for Rockwood's continuing shareholders also. From shortly before the tender until shortly after it, Rockwood stock appreciated from 15 to 100, even though the company was experiencing large operating losses. Sometimes there is more to stock valuation than price-earnings ratios. In recent years, most arbitrage operations have involved takeovers, friendly and unfriendly. With acquisition fever rampant, with antitrust challenges almost non-existent, and with bids often ratcheting upward, arbitrageurs have prospered mightily. They have not needed special talents to do well. The trick, a la Peter Sellers in the movie, has simply been being there. In Wall Street, the old proverb has been reworded. Give a man a fish and you feed him for a day. Teach him how to arbitrage and you feed him forever. If, however, he studied at the Ivan Boesky School of Arbitrage, it may be a state institution that supplies his meals. To evaluate arbitrage situations, you must answer 4 questions. 1. How likely is it that the promised event will indeed occur? 2. How long will your money be tied up? 3. What chance is there that something still better will transpire, a competing takeover bid, for example? And 4. What will happen if the event does not take place because of antitrust action, financing glitches, etc.? Arcata Corp., one of our more serendipitous arbitrage experiences, illustrates the twists and turns of the business. On September 28, 1981, the directors of Arcata agreed to, in principle, to sell the company to Kohlberg, Kravis, Roberts and Company, KKR, then and now a major leveraged buyout firm. Arcata was in the printing and forest products businesses and had one other thing going for it. In 1978, the U.S. government had taken title to 10,700 acres of Arcata timber, primarily old-growth redwood, to expand Redwood National Park. The government had paid $97.9 million in several installments for this acreage, a sum Arcata was contesting as grossly inadequate. The parties also disputed the interest rate that should apply to the period between the taking of the property and final payment for it. The enabling legislation stipulated 6% simple interest. Arcata argued for a much higher and compounded rate. Buying a company with a highly speculative, large-sized claim in litigation creates a negotiating problem, whether the claim is on behalf of or against the company. To solve this problem, KKR offered $37 per Arcata share plus 2/3 of any additional amounts paid by the government for the redwood lands. Appraising this arbitrage opportunity, we had to ask ourselves whether KKR would consummate the transaction since, among other things, its offer was contingent upon its obtaining satisfactory financing. A clause of this kind is always dangerous for the seller. It offers an easy exit for a suitor whose ardor fades between proposal and marriage. However, we were not particularly worried about this possibility because KKR's past record for closing had been good. We also had to ask ourselves what would happen if the KKR deal did fall through, and here we also felt reasonably comfortable. Arcata's management and directors had been shopping the company for some time and were clearly determined to sell. If KKR went away, Arcata would likely find another buyer, though of course the price might be lower. Finally, we had to ask ourselves what the redwood claim might be worth. Your chairman, who can't tell an elm from an oak, had no trouble with that one. He coolly evaluated the claim at somewhere between 0 and a whole lot. We started buying Arcata stock, then around $33.50 on September 30, and in 8 weeks purchased about 400,000 shares, or 5% of the company. The initial announcement said that the $37 would be paid in January 1982. Therefore, if everything had gone perfectly, we would have achieved an annual rate of return of about 40%, not counting the redwood claim, which would have been frosting. All did not go perfectly. In December, it was announced that the closing would be delayed a bit. Nevertheless, a definitive agreement was signed on January 4. Encouraged, we raised our stake, buying it around $38 per share and increasing our holdings to 655,000 shares, or over 7% of the company. Our willingness to pay up, even though the closing had been postponed, reflected our leaning toward a whole lot rather than zero for the redwoods. Then, on February 25, the lenders said they were taking a second look at financing terms in view of the severely depressed housing industry and its impact on Arcata's outlook. The stockholders' meeting was postponed again to April. An Arcata spokesman said he did not think the fate of the acquisition itself was imperiled. When arbitrageurs hear such reassurances, their minds flash to the old saying, "He lied like a finance minister on the eve of devaluation." On March 12, KKR said its earlier deal wouldn't work, first cutting its offer to $33.50, then 2 days later raising it to $35. On March 15, however, the directors turned this bid down and accepted another group's offer of $37.50 plus one-half of any redwood recovery. The shareholders okayed the deal, and the $37.50 was paid on June 4. We received $24.6 million versus our cost of $22.9 million. Our average holding period was close to 6 months. Considering the trouble this transaction encountered, our 15% annual rate of return, excluding any value for the redwood claim, was more than satisfactory. But the best was yet to come. The trial judge appointed 2 commissions, one to look at the timber's value, the other to consider the interest rate questions. In January 1987, the first commission said the redwoods were worth $275.7 million, and the second commission recommended a compounded blended rate of return working out to about 14%. In August 1987, the judge upheld these conclusions, which meant a net amount of about $600 million would be due Arcata. The government then appealed. In 1988, though, before this appeal was heard, the claim was settled for $519 million. Consequently, we received an additional $29.48 per share, or about $19.3 million. We will get another $800,000 or so in 1989. Berkshire's arbitrage activities differ from those of many arbitrageurs. First, we participate in only a few and usually very large transactions each year. Most practitioners buy into a great many deals, perhaps 50 or more per year. With that many irons in the fire, they must spend most of their time monitoring both the progress of deals and the market movements of the related stocks. This is not how Charlie nor I wish to spend our lives. What's the sense in getting rich just to stare at a ticker tape all day? Because we diversify so little, one particularly profitable or unprofitable transaction will affect our yearly result from arbitrage far more than it will the typical arbitrage operation. So far, Berkshire has not had a really bad experience, but we will, and when it happens, we'll report the gory details to you. The other way we differ from some arbitrage operations is that we participate only in transactions that have been publicly announced. We do not trade on rumors or try to guess takeover candidates. We just read the newspapers, think about a few of the big propositions, and go by our own sense of probabilities. At year-end, our only major arbitrage position was 3,342,000 shares of RJR Nabisco with a cost of $281.8 million and a market value of $304.5 million. In January, we increased our holdings to roughly 4 million shares, and in February, we eliminated our position. About 3 million shares were accepted when we tendered our holdings to KKR, which acquired RJR, and the returned shares were promptly sold in the market. Our pre-tax profit was a better than expected $64 million. Earlier, another familiar face turned up in the RJR bidding contest, Jay Pritzker, who was part of a First Boston group that made a tax-oriented offer. To quote Yogi Berra, it was déjà vu all over again. During most of the time when we normally would have been purchasers of RJR, our activities in the stock were restricted because of Solomon's participation in a bidding group. Customarily, Charlie and I, though we are directors of Solomon, are walled off from information about its merger and acquisition work. We have asked that it be that way. The information would do us no good and could, in fact, occasionally inhibit Berkshire's arbitrage operations. However, the unusually large commitment that Solomon proposed to make in the RJR deal required that all directors be fully informed and involved. Therefore, Berkshire's purchases of RJR were made at only 2 times. First, in the few days immediately following management's announcement of buyout plans before Solomon became involved, and considerably later after the RJR board made its decision in favor of KKR. Because we could not buy at other times, our directorships cost Berkshire significant money. Considering Berkshire's good results in 1988, you might expect us to pile into arbitrage during 1989. Instead, we expect to be on the sidelines. One pleasant reason is that our cash holdings are down because our position in equities that we expect to hold for a very long time is substantially up. As regular readers of this report know, our new commitments are not based on a judgment about short-term prospects for the stock market. Rather, they reflect an opinion about long-term business prospects for specific companies. We do not have, never have had, and never will have an opinion about where the stock market, interest rates, or business activity will be a year from now. Even if we had a lot of cash, we probably would do little in arbitrage in 1989. Some extraordinary excesses have developed in that takeover field. As Dorothy says, "Toto, I have a feeling we're not in Kansas anymore." We have no idea how long the excesses will last, nor do we know what will change the attitudes of government, lender, and buyer that fuel them. But we do know that the less the prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. We have no desire to arbitrage transactions that reflect the unbridled and, in our view, often unwarranted optimism of both buyers and lenders. In our activities, we will heed the wisdom of Herb Stein: if something can't go on forever, it will end. We told you last year that we expected to do little in arbitrage during 1989, and that's the way it turned out. Arbitrage positions are a substitute for short-term cash equivalents, and during part of the year we held relatively low levels of cash. In the rest of the year we had a fairly good-sized cash position, and even so chose not to engage in arbitrage. The main reason was corporate transactions that made no economic sense to us. Arbitraging such deals comes too close to playing the greater fool game. As Wall Streeter Ray DeVos says, "Fools rush in where angels fear to trade." We will engage in arbitrage from time to time, sometimes on a large scale, but only when we like the odds. Debunking standard dogma. The preceding discussion about arbitrage makes a small discussion of efficient market theory, EMT, also seem relevant. This doctrine became highly fashionable, indeed almost holy scripture, in academic circles during the 1970s. Essentially, it said that analyzing stocks was useless because all public information about them was appropriately reflected in their prices. In other words, the market always knew everything. As a corollary, the professors who taught EMT said that someone throwing darts at the stock tables could select a stock portfolio having prospects just as good as one selected by the brightest, most hardworking security analyst. Amazingly, EMT was embraced not only by academics, but by many investment professionals and corporate managers as well. Observing correctly that the market was frequently efficient, they went on to conclude incorrectly that it was always efficient. The difference between these propositions is night and day. In my opinion, the continuous 63-year arbitrage experience of Graham Newman Corp., Buffett Partnership, and Berkshire illustrates just how foolish EMT is. There's plenty of other evidence also. While at Graham Newman, I made a study of its earnings from arbitrage during the entire 1926 to 1956 lifespan of the company. Unleveraged returns averaged 20% per year. Starting in 1956, I applied Ben Graham's arbitrage principles, first at Buffett Partnership and then Berkshire. Though I've not made an exact calculation, I have done enough work to know that the 1956 to 1988 returns averaged well over 20%. Of course, I operated an environment far more favorable than Ben's. He had 1929 to 1932 to contend with. All of the conditions are present that are required for a fair test of a portfolio performance. 1. The 3 organizations traded hundreds of different securities while building this 63-year record. 2. The results are not skewed by a few fortunate experiences. 3. We did not have to dig for obscure facts or develop keen insights about products or managements. We simply acted on highly publicized events. And 4. Our arbitrage positions were a clearly identified universe. They have not been selected by hindsight. Over the 63 years, the general market delivered just under a 10% annual return, including dividends. That means $1,000 would have grown to $405,000 if all income had been reinvested. A 20% rate of return, however, would have produced $97 million. That strikes us as statistically significant differential that might conceivably arouse one's curiosity. Yet proponents of the theory have never seemed interested in discordant evidence of this type. True, they don't talk quite as much about their theory today as they used to. But no one, to my knowledge, has ever said he was wrong, no matter how many thousands of students he has sent forth misinstructed. EMT, moreover, continues to be an integral part of the investment curriculum at major business schools. Apparently, a reluctance to recant and thereby to demystify the priesthood is not limited to theologians. Naturally, the disservice done students and gullible investment professionals who have swallowed EMT has been an extraordinary service to us and other followers of Graham. In any sort of a contest, financial, mental, or physical, it's an enormous advantage to have opponents who have been taught that it's useless to even try. From a selfish point of view, Grahamites should probably endow chairs to ensure the perpetual teaching of EMT. All this said, a warning is appropriate. Arbitrage has looked easy recently, but this is not a form of investing that guarantees profits of 20% a year, or, for that matter, profits of any kind. As noted, the market is reasonably efficient much of the time. For every arbitrage opportunity we seized in that 63-year period, many were foregone because they seemed properly priced. An investor cannot obtain superior profits from stocks by simply committing to a specific investment category or style. He can earn them only by carefully evaluating facts and continuously exercising discipline. Investing in arbitrage situations, per se, is no better a strategy than selecting a portfolio by throwing darts. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. We are just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. We continue to think that it is usually foolish to part with an interest in a business that is both understandable and durably wonderful. Business interests of that kind are simply too hard to replace. Interestingly, corporate managers have no trouble understanding that point when they are focusing on a business they operate. A parent company that owns a subsidiary with superb long-term economics is not likely to sell that entity regardless of price. Why, the CEO would ask, should I part with my crown jewel? Yet that same CEO, when it comes to running his personal investment portfolio, will offhandedly and even impetuously move from business to business when presented with no more than superficial arguments by his broker for doing so. The worst of these is perhaps, you can't go broke taking a profit. Can you imagine a CEO using this line to urge his board to sell a star subsidiary? In our view, what makes sense in business also makes sense in stocks. An investor should ordinarily hold a small piece of an outstanding business with the same tenacity that an owner would exhibit if he owned all of that business. Earlier I mentioned the financial results that could have been achieved by investing $40 in the Coca-Cola Company in 1919. In 1938, more than 50 years after the introduction of Coke, and long after the drink was firmly established as an American icon, Fortune did an excellent story on the company. In the second paragraph, the writer reported, "Several times every year, a weighty and serious investor looks long and with profound respect at Coca-Cola's record, but comes regretfully to the conclusion that he is looking too late. The specters of saturation and competition rise before him." Yes, competition there was in 1938 and in 1993 as well. But it's worth noting that in 1938, the Coca-Cola Company sold 207 million cases of soft drinks, if its gallonage then is converted into the 192-ounce cases used for measurement today, and in 1993 it sold about 10.7 billion cases, a 50-fold increase in physical volume from a company that in 1938 was already dominant in its very major industry. Nor was the party over in 1938 for an investor. Though the $40 invested in 1919 in one share had, with dividends reinvested, turned into $3,277 by the end of 1938, a fresh $40 then invested in Coca-Cola stock would have grown to $25,000 by year-end 1993. I can't resist one more quote from that 1938 Fortune story. It would be hard to name any company comparable in size to Coca-Cola and selling, as Coca-Cola does, an unchanged product that can point to a 10-year record anything like Coca-Cola's. In the 55 years that have since passed, Coke's product line has broadened somewhat, but it's remarkable how well that description still fits. Charlie and I decided long ago that in an investment lifetime, it's too hard to make hundreds of smart decisions. That judgment became ever more compelling as Berkshire's capital mushroomed and the universe of investments that could significantly affect our results shrank dramatically. Therefore, we adopted a strategy that required our being smart, and not too smart at that, only a very few times. Indeed, we'll now settle for one good idea a year. Charlie says it's my turn. The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk using dictionary terms as the possibility of loss or injury. Academics, however, like to define investment risk differently, averring that is the relative volatility of a stock or portfolio of stocks, that is, their volatility as compared to that of a large universe of stocks. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, however, they forget a fundamental principle. It is better to be approximately right than precisely wrong. For owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark, so much so that it produces absurdities. For example, under beta-based theory, a stock that has dropped very sharply compared to the market, as had Washington Post when we bought it in 1973, becomes riskier at the lower price than it was at the higher price. Would that description have then made any sense to someone who was offered the entire company at a vastly reduced price? In fact, the true investor welcomes volatility. Ben Graham explained why in Chapter 8 of The Intelligent Investor. There he introduced Mr. Market, an obliging fellow noted above, who shows up every day to either buy from you or sell to you, whichever you wish. The more manic depressive this chap is, the greater the opportunities available to the investor. That's true because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. It is impossible to see how the availability of such prices can be thought of as increasing the hazards for an investor who is totally free to either ignore the market or exploit its folly. In assessing risk, a beta purist will disdain examining what a company produces, what its competitors are doing, or how much borrowed money the business employs. He may even prefer not to know the company's name. What he treasures is the price history of its stock. In contrast, we'll happily forgo knowing the price history, and instead we'll seek whatever information will further our understanding of the company's business. After we buy a stock, consequently, we would not be disturbed if markets closed for a year or two. We don't need a daily quote on our 100% position in C's or H.H. Brown to validate our well-being. Why then would we need a quote on our 7% interest in Coke? In our opinion, the real risk an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of interest on that initial stake. Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful. The primary factors bearing upon this evaluation are 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the reward from the business to the shareholders rather than to itself. 4. The purchase price of the business. And 5. The levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. These factors will probably strike many analysts as unbearably fuzzy since they cannot be extracted from a database of any kind. But the difficulty of precisely quantifying these matters does not negate their importance, nor is it insuperable. Just as Justice Stewart found it impossible to formulate a test for obscenity, but nevertheless asserted, "I know it when I see it," so also can investors, in an inexact but useful way, see the risks inherent in certain investments without reference to complex equations or price histories. The theoretician bred on beta has no mechanism for differentiating the risk inherent in, say, a single product toy company selling pet rocks or hula hoops from that of another toy company whose sole product is Monopoly or Barbie. But it's quite possible for ordinary investors to make such distinctions if they have a reasonable understanding of consumer behavior and the factors that create long-term competitive strength or weakness. Obviously, every investor will make mistakes, but by confining himself to a relatively few, easy-to-understand cases, a reasonably intelligent, informed, and diligent person can judge investment risks with a useful degree of accuracy. In many industries, of course, Charlie and I can't determine whether we are dealing with a pet rock or a Barbie. We couldn't solve this problem, moreover, even if we were to spend years intensely studying those industries. Sometimes our own intellectual shortcomings would stand in the way of understanding, and in other cases the nature of the industry would be the roadblock. For example, a business that must deal with fast-moving technology is not going to lend itself to reliable evaluations of its long-term economics. Did we foresee 30 years ago what would transpire in the television manufacturing or computer industries? Of course not, nor did most of the investors and corporate managers who enthusiastically entered those industries. Why then should Charlie and I now think we can predict the future of other rapidly evolving businesses? We'll stick instead with the easy cases. Why search for a needle buried in a haystack when one is sitting in plain sight? Of course, some investment strategies, for instance our efforts in arbitrage over the years, require wide diversification. If significant risk exists in a single transaction, overall risk should be reduced by making that purchase one of the many mutually independent commitments. Thus, you may consciously purchase a risky investment, one that indeed has a significant possibility of causing loss or injury, if you believe that your gain, weighted for probabilities, considerably exceeds your loss, comparably weighted, and if you can commit to a number of similar but unrelated opportunities. Most venture capitalists employ this strategy. Should you choose to pursue this course, you should adopt the outlook of the casino that owns a roulette wheel, which will want to see lots of action because it is favored by probabilities, but will refuse to accept a single huge bet. Another situation requiring wide diversification occurs when an investor who does not understand the economics of specific businesses nevertheless believes it is in his interest to be a long-term owner of the American industry. That investor should both own a large number of equities and space out his purchases. By periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. On the other hand, if you are a know-something investor able to understand business economics and to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification makes no sense for you. It is apt simply to hurt your results and increase your risk. I cannot understand why an investor of that sort elects to put money into a business that is his 20th favorite rather than simply adding that money to his top choices, the businesses he understands best and that present the least risk, along with the greatest profit potential. In the words of the prophet Mae West, too much of a good thing can be wonderful. We continually search for large businesses with understandable, enduring, and mouth-watering economics that are run by able and shareholder-oriented managements. This focus doesn't guarantee results. We both have to buy at a sensible price and get business performance from our companies that validates our assessment. But this investment approach, searching for the superstars, offers us our only chance for real success. Charlie and I are simply not smart enough, considering the large sums we work with, to get great results by adroitly buying and selling portions of far-from-great businesses. Nor do we think many others can achieve long-term investment success by flitting from flower to flower. Indeed, we believe that according the name investors to institutions that trade actively is like calling someone who repeatedly engages in one-night stands a romantic. If my universe of business possibilities was limited, say, to private companies in Omaha, I would first try to assess the long-term economic characteristics of each business, second, assess the quality of the people in charge of running it, And third, try to buy into a few of the best operations at a sensible price. I certainly would not wish to own an equal part of every business in town. Why then should Berkshire take a different tack when dealing with the larger universe of public companies? And since finding great businesses and outstanding managers is so difficult, why should we discard proven products? Our motto is, if at first you do succeed, quit trying. John Maynard Keynes, whose brilliance as a practicing investor matched his brilliance in thought, wrote a letter to a business associate, F.C. Scott, on August 15, 1934, that says it all. As time goes on, I get more and more convinced that the right method in investment is to put fairly large sums into enterprises which one thinks one knows something about and in the management of which one thoroughly believes. It is a mistake to think that one limits one's risk by spreading too much between enterprises about which one knows little and has no reason for special confidence. One's knowledge and experience are definitely limited, and there are seldom more than 2 or 3 enterprises at any given time in which I personally feel myself entitled to put full confidence. During 1987, the stock market was an area of much excitement but little net movement. The Dow advanced 2.3% for the year. You are aware, of course, of the roller coaster ride that produced this minor change. Mr. Market was on a manic rampage until October and then experienced a sudden massive seizure. We have professional investors, those who manage many billions, to thank for most of this turmoil. Instead of focusing on what businesses will do in the years ahead, many prestigious money managers now focus on what they expect other money managers to do in the days ahead. For them, stocks are merely tokens in a game, like the thimble and flatiron in Monopoly. An extreme example of what their attitude leads to is portfolio insurance, a money management strategy that many leading investment advisors embraced in 1986 to 1987. This strategy, which is simply an exotically labeled version of the small speculator's stop-loss order, dictates that ever-increasing portions of a stock portfolio or their index future equivalents be sold as prices decline. The strategy says nothing else matters. A downtick of a given magnitude automatically produces a huge sell order. According to the Brady Report, $60 billion to $90 billion of equity were poised on this hair trigger in mid-October of 1987. If you've thought that investment advisors were hired to invest, you may be bewildered by this technique. After buying a farm, would a rational owner next order his real estate agent to start selling off pieces of it whenever a neighboring property was sold at a lower price? Or would you sell your house to whatever bidder was available at 9:31 on some morning merely because at 9:30 a similar house sold for less than it would have brought on the previous day? Moves like that, however, are what portfolio insurance tells a pension fund or university to make when it owns a portion of enterprises such as Ford or General Electric. The less these companies are being valued at, says this approach, the more vigorously they should be sold. As a logical corollary, the approach commands the institutions to repurchase these companies, I'm not making this up, once their prices have rebounded significantly. Considering that huge sums are controlled by managers following such Alice in Wonderland practices, is it any surprise that markets sometimes behave in aberrational fashion? Many commentators, however, have drawn an incorrect conclusion upon observing recent events. They are fond of saying that the small investor has no chance in a market now dominated by the erratic behavior of the big boys. This conclusion is dead wrong. Such markets are ideal for any investor, small or large, so long as he sticks to his investment knitting. Volatility caused by money managers who speculate irrationally with huge sums will offer the true investor more chances to make intelligent investment moves. He can be hurt by such volatility only if he is forced, by either financial or psychological pressures, to sell at untoward times. Value investing, a redundancy. We really don't see many fundamental differences between the purchase of a controlled business and the purchase of marketable holdings. In each case, we try to buy into businesses with favorable long-term economics. Our goal is to find an outstanding business at a sensible price, not a mediocre business at a bargain price. Charlie and I have found that making silk purses out of silk is the best that we can do. With sow's ears, we fail. It must be noted that your chairman, always a quick study, required only 20 years to recognize how important it was to buy good businesses. In the interim, I searched for bargains and had the misfortune to find some. My punishment was an education in the economics of short-line farm implement manufacturers, third-place department stores, and New England textile manufacturers. Of course, Charlie and I may misread the fundamental economics of a business. When that happens, we will encounter problems whether that business is a wholly owned subsidiary or a marketable security, although it is usually far easier to exit from the latter. Indeed, businesses can be misread. Witness the European reporter who, after being sent to this country to profile Andrew Carnegie, cabled his editor, "My God, you'll never believe the sort of money there is running in libraries." In making both control purchases and stock purchases, we try to buy not only good businesses, but ones run by high-grade, talented, and likable managers. If we make a mistake about the managers we link up with, the controlled company offers a certain advantage because we have the power to effect change. In practice, however, this advantage is somewhat illusory. Management changes, like marital changes, are painful, time-consuming, and chancy. I would say that the controlled company offers two main advantages. First, when we control a company, we get to allocate capital, whereas we are likely to have little or nothing to say about this process with marketable holdings. This point can be important because the heads of many companies are not skilled in capital allocation. Their inadequacy is not surprising. Most bosses rise to the top because they have excelled in an area such as marketing, production, engineering, administration, or sometimes institutional politics. Once they become CEOs, they face new responsibilities. They now must make capital allocation decisions, a critical job that they may have never tackled and that is not easily mastered. To stretch this point, it's as if the final step for a highly talented musician was not to perform at Carnegie Hall, but instead to be named chairman of the Federal Reserve. The lack of skill that many CEOs have at capital allocation is no small matter. After 10 years on the job, a CEO whose company annually retains earnings equal to 10% of net worth will have been responsible for the deployment of more than 60% of all the capital at work in the business. CEOs who recognize their lack of capital allocation skills, which not all do, will often try to compensate by turning to their staffs, management consultants, or investment bankers. Charlie and I have frequently observed the consequences of such help. On balance, we feel it is more likely to accentuate the capital allocation problem than to solve it. In the end, plenty of unintelligent capital allocation takes place in corporate America. That's why you hear so much about restructuring. Berkshire, however, has been fortunate. At the companies that are our major non-controlled holdings, capital has generally been well deployed and, in some cases, brilliantly so. The second advantage of a controlled company over a marketable security has to do with taxes. Berkshire, as a corporate holder, absorbs some significant tax costs through the ownership of partial positions that we do not when our ownership is 80% or greater. Such tax disadvantages have long been with us, but changes in the tax code caused them to increase significantly during 1986. As a consequence, a given business result can now deliver Berkshire financial results that are as much as 50% better if they come from an 80% or greater holding rather than from a lesser holding. The disadvantages of owning marketable securities are sometimes offset by a huge advantage. Occasionally, the stock market offers us the chance to buy non-controlling pieces of extraordinary businesses at truly ridiculous prices, dramatically below those commanded in negotiated transactions that transfer control. For example, we purchased Washington Post stock in 1973 at $5.63 per share, and per-share operating earnings in 1987 after taxes were $10.30. Similarly, our Geico stock was purchased in 1976, 1979, and 1980 at an average of $6.67 per share, and after-tax operating earnings per share last year were $9.01. In cases such as these, Mr. Market has proven to be a mighty good friend. Our equity investing strategy remains little changed from what it was when we said in the 1977 annual report, we select our marketable equity securities in much the way we would evaluate a business for acquisition in its entirety. We want the business to be one that we can understand with favorable long-term prospects operated by honest and competent people and available at a very attractive price. We have seen cause to make only one change in this creed. Because of both market conditions and our size, we now substitute an attractive price for a very attractive price. But how, you will ask, does one decide what's attractive? In answering this question, most analysts feel they must choose between two approaches customarily thought to be in opposition: value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. We view that as fuzzy thinking, in which, it must be confessed, I myself engaged some years ago. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. In addition, we think the very term value investing is redundant. What is investing if it is not the act of seeking value, at least sufficiently to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold for a still higher price should be labeled speculation, which is neither illegal, immoral, nor, in our view, financially fattening. Whether appropriate or not, the term value investing is widely used. Typically, it connotes the purchase of stocks having attributes such as a low ratio of price to book value, a low price-earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price-earnings ratio, and a low dividend yield, are in no way inconsistent with a value purchase. Similarly, business growth per se tells us little about value. It's true that growth often has a positive impact on value, sometimes one of spectacular proportions, but such an effect is far from certain. For example, investors have regularly poured money into the domestic airline business to finance profitless or worse growth. For these investors, it would have been far better if Orville had failed to get off the ground at Kitty Hawk. The more the industry has grown, the worse the disaster for owners. Growth benefits investors only when the business in point can invest at incremental returns that are enticing. In other words, only when each dollar used to finance the growth creates over $1 of long-term market value. In the case of a low-return business requiring incremental funds, growth hurts the investor. In The Theory of Investment Value, written over 50 years ago, John Burr Williams set forth the equation for value, which we condense here. The value of any stock, bond, or business today is determined by the cash inflows and outflows discounted at an appropriate interest rate that can be expected to occur during the remaining life of the asset. Note that the formula is the same for stocks as for bonds. Even so, there is an important and difficult to deal with difference between the two. A bond has a coupon and maturity date that define future cash flows, but in the case of equities, the investment analyst must himself estimate the future coupons. Furthermore, the quality of management affects the bond coupon only rarely, chiefly when management is so inept or dishonest that payment of interest is suspended. In contrast, the ability of management can dramatically affect the equity coupons. The investment shown by the discounted flows of cash calculation to be the cheapest is the one that the investor should purchase, irrespective of whether the business grows or doesn't, displays volatility or smoothness in its earnings, or carries a high price or low price in relation to its current earnings and book value. Moreover, though the value equation has usually shown equities to be cheaper than bonds, that result is not inevitable. When bonds are calculated to be the more attractive investment, they should be bought. Leaving the question of price aside, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. The worst business to own is one that must or will do the opposite, that is, consistently employ ever greater amounts of capital at very low rates of return. Unfortunately, the first type of business is very hard to find. Most high-return businesses need relatively little capital. Shareholders of such a business usually will benefit if it pays out most of its earnings in dividends or makes significant stock repurchases. Though the mathematical calculations required to evaluate equities are not difficult, an analyst, even one who is experienced and intelligent, can easily go wrong in estimating future coupons. At Berkshire, we attempt to deal with this problem in two ways. First, we try to stick to businesses we believe we understand. That means they must be relatively simple and stable in character. If a business is complex or subject to constant change, we're not smart enough to predict future cash flows. Incidentally, that shortcoming doesn't bother us. What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. An investor needs to do very few things right as long as he or she avoids big mistakes. Second, and equally important, we insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham, to be the cornerstone of investment success. An intelligent investor in common stocks will do better in the secondary market than he will do buying new issues. The reason has to do with the way prices are set in each instance. The secondary market, which is periodically ruled by mass folly, is constantly setting a clearing price. No matter how foolish that price may be, it's what counts for the holder of a stock or bond who needs or wishes to sell, of whom there are always going to be a few at any moment. In many instances, shares worth X in business value have sold in the market for half X or less. The new issue market, on the other hand, is ruled by controlling stockholders and corporations who can usually select the timings of offerings or, if the market looks unfavorable, can avoid an offering altogether. Understandably, these sellers are not going to offer any bargains, either by way of a public offering or in a negotiated transaction. It's rare you'll find X for half X here. Indeed, in the case of common stock offerings, selling shareholders are often motivated to unload only when they feel the market is overpaying. These sellers, of course, would state the proposition somewhat differently, averring instead that they simply resist selling when the market is underpaying for their goods. Right after year-end, Berkshire purchased 3 million shares of Capital Cities ABC Inc., Cap Cities, at $172.50 per share, the market price of such shares at the time the commitment was made in early March 1985. I've been on record for many years about the management of Cap Cities. I think it is the best of any publicly owned company in the country. And Tom Murphy and Dan Burke are not only great managers, they are precisely the sort of fellows you would want your daughter to marry. It's a privilege to be associated with them and also a lot of fun, as any of you who know them will understand. Our purchase of stock helped Cap Cities finance the $3.5 billion acquisition of American broadcasting companies. For Cap Cities, ABC is a major undertaking whose economics are likely to be unexciting over the next few years. This bothers us not an iota. We can be very patient. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. As evidence of our confidence, we have executed an unusual agreement. For an extended period, Tom, as CEO, or Dan, should he be CEO, votes our stock. This arrangement was initiated by Charlie and me, not by Tom. We also have restricted ourselves in various ways regarding sales of our shares. The object of these restrictions is to make sure that our block does not get sold to anyone who is a large holder or intends to become a large holder without the approval of management, an arrangement similar to ones we initiated some years ago at Geico and Washington Post. Since large blocks frequently command premium prices, some might think we have injured Berkshire financially by creating such restrictions. Our view is just the opposite. We feel the long-term economic prospects for these businesses, and thus for ourselves as owners, are enhanced by the arrangements. With them in place, the first-class managers with whom we have aligned ourselves can focus their efforts entirely upon running the businesses and maximizing long-term values for owners. Certainly, this is much better than having those managers distracted by revolving-door capitalists hoping to put the company in play. Of course, some managers place their own interests above those of the company and its owners and deserve to be shaken up, but in making investments, we try to steer clear of this type. Today, corporate instability is an inevitable consequence of widely diffused ownership of voting stock. At any time, a major holder can surface, usually mouthing reassuring rhetoric but frequently harboring uncivil intentions. By circumscribing our blocks of stock as we often do, we intend to promote stability where it otherwise might be lacking. That kind of certainty, combined with a good manager and a good business, provides excellent soil for a rich financial harvest. That's the economic case for our arrangements. The human side is just as important. We don't want managers we like and admire, and who have welcomed a major financial commitment by us, to ever lose any sleep wondering whether surprises might occur because of our large ownership. I have told them there will be no surprises, and these agreements put Berkshire's signature where my mouth is. That signature also means the managers have a corporate commitment and therefore need not worry if my personal participation in Berkshire's affairs ends prematurely, a term I defined as any age short of 3 digits. Our Cap Cities purchase was made at a full price, reflecting the very considerable enthusiasm for both media stocks and media properties that has developed in recent years, and that, in the case of some property purchases, has approached a mania. It's no field for bargains. However, our Cap Cities investment allies us with an exceptional combination of properties and people, and we like the opportunity to participate in size. Of course, some of you probably wonder why we are now buying Cap Cities at $172.50 per share, given that your chairman, in a characteristic burst of brilliance, sold Berkshire's holdings in the same company at $43 per share in 1978 to 80. Anticipating your question, I spent much of 1985 working on a snappy answer that would reconcile these acts. A little more time, please. Intelligent investing. Inactivity strikes us as intelligent behavior,